Let's talk to David Paul. He's the Managing Director of VectorVest UK. Morning to you, young David.
Yes, good morning, Russ. How are you doing?
We've got a number of slides to go through. Obviously, tricky times in the market. You were here last week suggesting that the long-term trend was up, the short-term trend on your model was down. I assume you're sell now, short and long term.
That's correct. We've been telling people not to buy any shares since the 17th of January.
Yep.
That's when the short-term trend turned down. And now the long-term trend is down, the short-term trend is down. So it's time to sit and watch shares very carefully. Certainly short-term traders or swing traders could have been short either the index or shorted some shares that had been underperforming since the 17th. I personally have been short the FTSE since the 17th of January.
Very good. Okay, well, let's talk about relative safety. We've got a slide here. What's this all about?
Well, what I want to talk about today was our most conservative investing methodology for these times. Every day, VectorVest sorts all of the shares in the London stock market by value, safety of earnings, and the trend. And in worry-free investing, we in fact sort all of the shares on the market just by relative safety. And relative safety looks at the safety and the predictability of the earnings, and the algorithm looks at the balance sheet, the income statement, the cash flow statement, all those accounting ratios, and makes a judgment as to whether the financial performance of this company is getting better or worse. Mathematically massages all those numbers into a score between 0 and 2. Above 1 is fair, above 1.3, and this is a company that's making lots and lots of money, and all those ghastly financial ratios are getting better. And in worry-free investing, we only buy the top relative safety shares. We advise our customers to buy 10, diversify themselves across the market in the top RS shares. For example, Cranswick, the sausage manufacturer, is an RS share. Legal & General is, Prudential is. And those shares, in fact, haven't come back much at all over the last day or two.
Okay. Understood. Okay, well, let's move swiftly on to how it works.
Well, we've been working on this now for the last 25 years. We've tested it over the last 25 years in the US. When we get an up signal, one of those long-term up signals, we buy the top 10 RS shares, diversifying ourselves across the market. When the market is rising, there's a very low probability of getting stopped out of one of those shares, and we calculate a stop loss for each share every day. It could happen, however, if its company drops the ball. If we get stopped out of a share and the general market is still rising, we resort and we replace with the share that we're not currently holding, so that when the general market is rising, we're 100% invested. Now, sooner or later, we're going to get a down signal. Markets breathe in, they breathe out, as we've seen in the last day or two. When we get a down signal, we're much more likely to get stopped out of one of those shares. And if we do get stopped out of one of those shares, we do not replace, we build a cash position. So if we were to get a marked sell-off and we get stopped out, let's say, of 3 of the 10 shares that we're holding, we'd now be 70% in shares and 30% in cash. When we get the next confirmed up signal, the next buy signal, then we would resort again and we'd replace those 3 shares so that we're fully invested when the general market is rising. And it's something that you can keep under control in a few minutes a day, and we have it all automated on your smartphone, so it doesn't matter how busy you are, you can get a second or 2 a day to actually keep it under control.
Understood. Okay, let's talk about capital appreciation.
Well, the objectives are capital appreciation, the objectives are dividends, and if you're in an environment and you understand options, then you could certainly write covered calls on some of the shares that you've got. Now, in the UK, the retail investor has got a limited opportunity to actually write options, but certainly in the US, if you were to apply this to the US market, then it's very, very easy to write options to add a little bit more income to the mix.
Yep, cover calls, we like those.
Yeah.
Okay, so let's take a look at the longer term winners.
Well, that's the track record from 1996 to 2016 in varying market types. The run up into 2000, the sell off to 2003, and the run up to 2007, the crisis, and then the bull market that's been around ever since. There was 177 trades placed in that time, so that's a trade pretty much every 6 weeks. So this is not aggressive high-frequency trading. We collected $51,000 worth of dividend income along the way from a $100,000 initial portfolio in that 20 years. Now, in the next chart, which is the performance chart, I didn't add the dividends, so just assume that you spent the dividends on best bidder or something.
Very good.
Clearly it wasn't easy. You can see from 2000 to 2003.
The drawdowns are quite minimal, aren't they?
Yeah, the drawdowns are minimal. When I take this into the city, people don't believe it. But it is what it says in the tin, that ghastly advert, in that it is worry-free investing, where we're investing in the shares that with a strong performance record that don't pull back that much in bad times.
Understood. Okay, well, let's talk about the back testing.
And that's in the UK. I started that. That started in 2009, and £50,000 has turned into £235,000 since 2009, and that's about 18% a year. And in that, I haven't included any of the dividends. And these worry-free shares invariably pay quite a nice little dividend of 2.5 or 3%. That makes an enormous difference if I'd added those in, but I haven't added those into that particular chart. And similarly, even Brexit, the Brexit vote, should I say, didn't do it that much harm. It recovered from that relatively quickly.
Okay, well, let's wrap up with some headlines. You've got a couple of events coming up, haven't you?
Well, yes, I've got a seminar on the worry-free technique that we've talked about very briefly in the last couple of minutes. And then I've got another seminar on swing trading with VectorVest for those people that want to actually add a little bit of leverage and spice to their life and short-term trading.
Okay. In terms of your website, shout that out.
Well, it's VectorVest.co.uk. The worry-free seminar is in the evening at Chesterfield Hotel in Mayfair, and the swing trading seminar is a full Saturday, and that's at the Holiday Inn in Regent's Park. They're all on the website towards the end of February.
David, as always, thank you very much.
Thank you, Mus.